Stocks are trying to rebound on the back of some good economic data this week with the economy and the jobs. Earnings are kind of mixed, a little bit all over the board. Some earnings, some companies are coming out decent, some are missing. We had positive GDP growth. We've got a good, strong jobs market, and then we just got the labor report today that less people were filing for unemployment than expected. So generally, that's going to be good news, but at the same token, it's bad news. Good news is bad news these days, and bad news is good news. And we'll take a look at all that in just a second. But right now, about an hour and a half left to close. NASDAQ is pretty flat, S&P flat, Dow Jones flat, and all from being down a little bit this morning in the pre-markets to up a little bit later in the morning to back around flat today. And again, the key is to watch the momentum into the close. That's where you can really engage the investor sentiment is by the price action into the close. But basically the jobs are for July 2023. Here's where the jobs are for July 2023 of one chart. The total jumped to 100,000 when including education jobs. Healthcare added 87,100. So there was 187,000 jobs created for the recent report that came out. Of course, healthcare, construction, financial services, things like that. So, that's good that 187,000 were created, but the projections were 200,000. So it came in softer than projected. The unemployment claims were on par with that report last week. This is the, job creation here. So a little softer than expected. So in one sense, that is potentially a good sign for the Fed in terms of a narrative to not hike, because that's the big debate. Is the Fed going to hike at the next meeting? Right now, with the inflation coming down, although we are going to see a little bit of a spike in August numbers in September before the next Fed meeting. The Fed does not have a meeting in August, but they will. Jerome Powell will be speaking at Jackson Hole next week, and we'll get a lot of color from that speech in terms of what he's thinking about policy, data dependent, live meeting, all that kind of stuff that we've seen. But the way it looks right now with the jobs data, with inflation, disinflation happening, the Fed has a very good case not to hike. Several Fed speakers that have been out here in the last week have said that they're going to pause, or that they are recommending a pause in September, that they don't see any need to hike in September. But we have more economic data to come out again. August inflation is going to be an issue because food's gone up, energy's gone up with oil and gas and things like that. So you might see a little bit of a spike there. So it'll be interesting to see how the Fed reacts to that. And we'll get a lot of color at the Jackson Hole meeting. We're going to have a lot of Fed speakers after that going into the September meeting. So we'll have a really good indication, as they do like to telegraph what they're going to do. They don't like to surprise the markets. And of course, inflation still remains the hot topic. And then again, the debate is, can inflation get below 3%? Will the Fed be able to bring it below 3%? But the one thing that's evident is they're not going to be cutting rates anytime soon. With the economy is humming along as good as it is, with positive growth, with prices still elevated above the 2%, target range, which anything under 3 is within target range. Closer to 2.5, I think would be acceptable for the Fed, but they say 2%, but that's a relative number. So the economy is humming along good. So there is no base case for them to reduce rates. But the one thing I want to look at, I put a tweet out the other day with X and Twitter and tweet, what is it called now? And I said, what does this chart tell you? And this was the federal funds historical chart going back to 1955. And you can see where we're at right now with a 5. Now it's up at 5.25. The last time we were there was in 2006, where the Fed funds rate hit 5.25%. Prior to that, we see this area here where Fed rates hit, 5.9, almost 6%, into that 5.5% range, which is where we're headed. That was 95 time frame through early 2000, and then it peaked at 6.52 in 2000 before the dot-com bust, then rode off. And then right here, it started spiking 0405. That was the peak of the housing market back in 0405 before the great financial crisis. Rates started going up. And once it hit that 5.25 level, that was it. Markets couldn't take it. Housing market imploded and it rolled over. So the real question that I was looking at is, we're approaching that level now. Is that going to create some sort of a problem? It's not going to be in housing. The housing market is very strong. There's limited inventory, record low rates that most homeowners have. 60% of the mortgages out there are below. I believe it's 4%, and a good number of them are below 3%. 40% of the houses are owned free and clear. There's a lot of cash purchases. So the housing market, in terms of the borrowers, the mortgages and things like that, is very healthy. In terms of the housing market itself, it's very unhealthy because prices are still up. There's no inventory. Rates are now in the sevens. So that could slow things down for a little bit and allow some inventory to build. But people that have 2 and 3% mortgages, there's just no incentive for them to sell because every seller becomes a buyer and there's nothing to buy out there. So not only do they not want to get out of that rate and then go pay more for a house somewhere, it's going to cost them twice as much as their existing house in terms of the mortgage, but there's nothing to choose from, even if they did decide to do that. But anyways, I put that tweet out. What does this chart tell you? And that's what it told me. What I'm looking at is the Fed funds rate just hit the same level as August 2006, coming off an aggressive Fed hiking cycle preceding the 2009 GFC. It took 2 years to play out. Policy has long and variable lags. We hear that from Powell all the time. Will this time be different? So that's what we're looking at. Is this time going to be different? As far as markets go, wrestling with that 786 level. So these are Fibonacci retracements, and you can see all along the way, price action reacts to these Fibonacci levels because these are where the automated trading and algorithmic trading calculations are made for stop loss action and things like that. So these are important levels here that the trading machines put in there when price does this, do that. So you can see that it wrestles with these levels. What you're looking for continuation is support above the 786 to continue on. Right now, price has not found support above it on any of the indexes yet. In fact, rejected perfectly on the S&P, somewhat rejecting on the NASDAQ, and the Dow breaking back down below it again and rejecting. So you could see continuation down and start playing with that 702. What does that look like in terms of an overall drawdown? Some people are calling for a 10% drawdown in the stock market, but back to the 702 level would be a 3% on the Dow. The 618 would be a 5%. That 0.5 retracement, which is a normal retracement after a nice little run like we've had, would be 7-8% down. 10% will put you down to 382. So some people are calling for a 3 to 5% retracement or correction. Some people are calling for a 10% correction. All we know right now is we've got about a 2 to 3% correction on all the indexes, and markets are trying to finish positive for today, but we'll see if they will. Pretty much all across the board, everything wrestling with that 786 and the SPY, the Qs, NASDAQ, and all that. VIX is trying to have a little spike here. Last time VIX spiked to this level was July 2023. We had a little bit of a pullback there. It spiked all the way up to 17, but up in these levels here, May of 2023 were our last, high levels of the VIX up in the 20s. And then, of course, that March area where VIX hit the 30s, and then the October levels where the VIX hit the mid 30s to 40s. So we're still a long way away from that. But if you get a VIX event where it spikes up into the 30s to 40s, that's where you're talking October lows once again. Dixie kind of pulling back today on debt downgrades and things like that. And we have the 2-year and the 10-year kind of pulling back a little bit, but looking, holding support right here on these previous levels on the 10-year. Possibly looking for continuation there on the debt downgrade. Got a mixed, point of view on the debt downgrade. Was it warranted? Was it not warranted? What they're looking at is the levels of debt that we're experiencing in the economy right now. And we'll talk about that in a second. Is that sustainable? Is it unsustainable? Let's take a look at gold here. Gold having a little bit of a bounce after a pullback. Same thing with silver. The metals have taken a little bit of a hit here lately with everything that's going on. And then, of course, Bitcoin just kind of sailing along right here, still in distribution. So, in this rising channel, which many times, as we've seen in the past, is broken to the downside. And if we put a Fibonacci retracement on this, and we can see these levels from the lows to the highs of these runs, working its way to the 236, which would be a normal pullback, then the 382, then the 0.5, and you can see the price points on all these levels right now. The 236 kind of intersecting with this bottom of the trend line, coming in around 28,000 plus or minus, depending on when it actually hits. So that's our next thing that we're going to be looking for is, will this trend line hold with these higher lows, and will this be another higher low and continue on, or will it break the trend line, reject and reverse down? And that's where you can start looking for some of these lower targets, and you can see the areas of confluence, right through here with this area of support back in February of 2023, August of 2023. You can see these peaks here. That's around 25 too. Then you start breaking below there. You've got another little level of confluence at 21. And then, of course, your next stop's going to be in the 18s, and then, back down. So, this rising channel is very similar to this rising channel we saw, this rising channel, this one here, all the way down, just kind of stepping us down. This has been a real big one. And ideally, we have the halving coming up. So, normally you would see a retracement into the halving, and then price could take off from there, with the 4-year cycle. I've marked out those halving events. Maybe I'll do that in the next video so we can kind of take a look at that. So right now, as long as the market can continue on, the economy can stay healthy, and the Fed doesn't get super aggressive, and we don't have any events, then, Bitcoin can continue to consolidate, pull back a little bit, and, into that halving, and then move on from there. And again, if you get the Bitcoin ETF approvals, I think price will real quickly get back to these previous all-time highs, potentially beyond. You're just going to have so much capital that is available to come into the market with all the registered investment advisors out there, the money managers. They want a spot Bitcoin ETF so they can get their clients into it. They will be highly incentivized to do it. And the funds that are filing for these ETFs will be spending a lot of money to bring their clients into the space. So there'll be a big education campaign push. So a lot of capital could potentially come into the space. That's when you can get the pension funds in, the life funds, the real institutional players where, trillions of dollars of investable capital is available to enter the space. And that's where you can start looking at some of those upward targets of the previous all-time highs to the 100,000 level pretty quick. So, and if it gets rejected, then, you might see a pretty quick pullback for a little while, and then another consolidation, and, run into the normal cycles of Bitcoin. The real question is, will the halving have the same network effect it's had in the past? Does it really matter in terms of people rushing, wanting to try to get Bitcoin, ahead of that halving or into the halving, because the amount of Bitcoin that is mined is going to get cut in half? We'll just have to wait and see. Ethereum still kind of plugging along here, same thing, putting in the higher lows. Will this trend line hold for Ethereum? Nobody knows. And then the rest of the altcoin market just kind of hanging out with a potential, with more potential downside in the altcoin market. We've looked at that before. If we look at the total 3, which is everything minus Ethereum, you still have, in terms of reversion to the mean, you still have a lot of room for this market to fall, another 50% potentially. So, that potential is on the table for a lot of the altcoins. So if that does happen, that should create some good buying opportunities. And in terms of, what we were talking about with the debt load and everything, one of the lines of thinking, there's what's called modern monetary theory, where the modern monetary theorist, this is not my theory, I do not subscribe to the theory, but the thinking is that, the government is not like a household. So it doesn't have to maintain a balance in its checkbook. It's not on a budget in that sense, because it's the world reserve currency. It can print enough, it can print all at once to sustain the debt, to pay the bills and things like that. So in essence, the debt doesn't really matter because it can print to service the debt. So if I borrowed money from you, and you knew that I had a printer that could print unlimited amounts of money to pay you back that you could use around the world, you would keep lending me money. And it doesn't really matter how much I borrow, what the interest rate on that debt is, because I can just print the money. And as long as that doesn't create inflation at the consumer level, then it really doesn't matter. It's a non-issue because the people that we're paying the interest payments to are basically holding those dollars for trade around the world. So it's going to put price, it's going to put pressure on, financial assets, global risk assets around the world. They might park that, ultimately reinvesting into bonds and treasuries and things like that. And it could potentially affect, trade around the world at some point, but it would take a lot because it's a huge, huge world economy. So that's the modern monetary theory, is that, the government doesn't have to worry about balancing the checkbook. They can print unlimited money because we're the world's reserve currency. So the debt doesn't matter, and the interest on the debt doesn't matter when you can just print to service that debt. So that is the theory. And again, it's just a theory. And as we know, theories only get you so far. So, and again, that's not my opinion or my perspective. It's just what it is, so just kind of, why the politicians, some may or may not be worried about it. So the question is our debt unsustainable? We're going to find out. So these are the things I'm looking at. This channel is all about entrepreneurship, real estate investing, stocks, Bitcoin, crypto. These are the things we talk about on this channel. And I will see you on the next video.